Good morning, I'm Chris Peach, and welcome to Charting the Markets on IG Live. And it's really the start of the busy week, the busy period of the week anyway. Yesterday was a bit of a warm-up, but today we've already had numbers from the likes of Whitbread, Associated British Foods in the UK, and then it just gets busier from there. McDonald's, Visa, Alphabet, I'm just thinking of these as I go, Microsoft, of course, all today, and that's just the beginning. From here, it gets manic in terms of earnings releases in the US. And of course, GDP on Friday. So not surprisingly, markets don't really know which way to turn. We've had some early dips for indices this morning, but the European markets coming back a bit. Unsurprisingly, the NASDAQ under pressure. So much of the really big heavyweights in the NASDAQ 100 reporting this week. And of course, they're the stocks that have driven the rebound in US equity markets this year. Around 2/3, I think it is the stat, 2/3 of the gains in the S&P 500, the broad index, have been driven by about 4 stocks, which is the most impressive contribution they've made since 2000. That might ring alarm bells for some, but it's only a single example, so it's not really much evidence to go on. But of course, with Apple, Microsoft, Amazon, all on the calendar this week, it does mean that the tech stocks are under some pressure, understandably. We'll look at that in a second. Otherwise, commodity markets seen a bit of a mixed performance thus far, but oil prices rebounded yesterday, so that's one thing to keep an eye on. Maybe they've recouped some of, they've maybe managed to stabilize themselves after the losses they suffered last week, closing most of the gap from that OPEC production cut. But starting with indices, and beginning as ever with the FTSE 100, currently trading at 78.90. It feels like we've been here for quite some time, as indeed we have. The index hit 7,900 again on the 14th of April, and since then we've essentially oscillated around that point, around a fixed point. We've been as high last Friday as 79.38, and today we've hit the 2-week low down about 78.60. But no real progress in either direction. Consolidation is the name of the game here. Unsurprisingly, after the huge move higher from those March lows all the way down at 7,200 for the FTSE 100 as the banking crisis really hit, and then huge rally, decent recovery, and then unsurprisingly, it has stalled for now. So the question now is, where do we go from here? Well, it certainly isn't showing any inclination to move down, just as much as it's not really showing any desire to move higher. And while this is, of course, frustrating for those, say you bought the lows in March, or you bought into the up rally in March, you are going to wonder, well, is it going to turn around and wipe out my profits, or is it going to keep going higher from here? And of course, you just don't know. But the risk, of course, is that at the moment, with, you can argue, maybe a more optimistic view starting to prevail across markets, it might continue to push higher. And indeed, for the FTSE 100, of course, it has held on to its gains since October. That long rebound from down at 6,800 took us to 8,000 more or less. And as we saw here, the dip buyers came back in again during the March weakness, the banking crisis, to drive it back again. So it hasn't completely turned lower. Yes, it remains below these February highs above 8,000, but it hasn't shown much of a desire to head lower than about 78.50. So the bear issue is in abeyance for the time being, I think. We could argue perhaps it might start to pull back towards the 50-day, but otherwise, for the time being, I would still argue that the most obvious argument here is that you expect to see this trend continue, and thus maybe another test of 8,000 and higher results. And beyond that, of course, takes the FTSE 100, to a record high. Turning to Germany, the DAX 40, of course, clinging on at its highest level since January of last year, really. And again, it is just moving sideways. We've had a big rally. For the DAX, it's been an absolutely impressive rebound from the September lows down at 11,800. We gained into the March highs, percentage around about 32%, and as of now, we're up 33.8% from those lows in September. We were discussing this actually early this morning with a few clients, arguing why have European markets been so strong? Partly because they're cheaper than the US. There's no tech in it, which at the moment is a really good thing, or has been for European markets. The lack of any expensive tech stocks, high valuations when rising rates aren't great. So the absence of that has helped European markets. Also, the fact that by August and September, people were very worried that an energy crisis was looming in Europe. There wouldn't be enough gas to go around, or that the wood would be available to high prices that would cause a major hit to the European economy and possibly tip it into recession. That didn't happen. So price leading the way, saw a huge rebound in European markets that, as we can see in this trend, have been willing to buy into the dips all the way through. So the dip in December down towards, say, 14,000, buyers came in after some consolidation for 2 weeks, and then it rallied again. And then you had the banking crisis, which didn't affect European markets as much as it did the US and the UK. So while you did see losses for the DAX particularly, down to about 14,500, sprung higher once again and back onto this 1-year high. We essentially, I mean, you look at Monday's high, in fact, was it just nudged, I think it just nudged into a new high, 15,919. Oh no, I stand correct. Last Wednesday's high, 15,923, 924 really was the highest level since January 2022. But we're, what, 60 points away from that. So it really isn't showing any desire to turn lower at this point in time. So therefore, the most obvious view is that the trend will continue. If it does start to pull back below 15,600, that could be a clue that maybe we see another test with the 100-day at some point. But for the time being, the buyers just doing their best to hold this one in place. And perhaps once earnings are out the way, maybe we'll see another attempt to push on towards 16,000 and 16,300, which would be the highest levels here for the DAX since December 2021. And then over to the NASDAQ, it's tech earnings week. There's no escape from it, really. It's not surprising to see the NASDAQ down all of, 300 points from the highs we saw at the end of March. But with so much riding on the reports this week and indeed into next week, you might just see this index struggle for the time being, because even once you get Microsoft and Alphabet out of the way today, there's more to come. So that just could hold the index back in the short term. But it is still creating those higher highs and higher lows. So the uptrend is there. It's recouped some of the losses of 2022, not very much. You can see how huge the decline was and how much ground needs to be made up here. But a reversal and a move back above 13,200 then targets that August high, 13,700 or so. If it can get to there, then you would continue to argue for a bullish view in medium term. If a pullback does materialize, it would have to go really all the way back below 11,900 to really start to suggest that actually the sellers are firmly in control once again with this. So as you can see, just as much for the NASDAQ as for the other two indices, there's a lot of work for the sellers to do to really change the view here from just saying, oh, it's going to pull back towards that it will actually turn back and drop back below the lows of March and then start to reignite the 2022 downtrend. FX markets relatively quiet by comparison. We do get US consumer confidence this afternoon and home sales, but nothing earth-shattering in its importance. At the moment, of course, as we can see with euro-dollar, the driver has been the fact the ECB is still banging the drum on maybe even a 50 basis point rate hike. So that has meant that the euro-dollar has been able to hold around 110, not be able to push higher, but certainly aiming for further gains. But with US GDP, the Q1 GDP reading expected this week, and GDP from Germany as well, I think, it does mean that there is plenty of data that could drive this one, and in either direction at this point. But nonetheless, really, it's just a continuation of the theme of risk. Risk recovered back in September and October for euro-dollar. That saw it go from 99.96 against the dollar, back up now to where it is at 110. And the buyers came in. Again, to repeat myself, they came in during February and March. The pullback, as you might expect from this impressive high after the really good rebound from the September lows, we got to 110, back down again, defending either you can call it the 100-day moving average or the zone of support around 105.30, or indeed both. Buyers came in, pushed it back higher. The question is now, where do we go from here? Further upside, then targets this potentially interesting area around 111.50, which is around the lows from January of 2022 and the peak from the end of March 2022. So that's your next target. And then beyond, you're moving into the highs for January and February of last year around 114.50. And as I say, with indices, you have a lot of downside needed to really change the view here. Same for euro-dollar. In first instance, any pullback that continues to head back down towards 105 would be obviously concerning. Close below that starts to reverse the view. But for the moment, after this rebound from the March lows, the buyers remain in charge here. Perhaps somewhat paradoxically too, the pound still holding up relatively well, waiting further news, I think, and not much from the UK this week in terms of data. That was last week and the week before. So at the moment, the focus has been on maybe what the BOE will do next. But with, as we saw last week, inflation rising and wage growth still strong, there is still an argument to be made for further rate hikes, even as the economy begins to come under a bit more pressure. So there we are on that front. The same sort of fundamental factors apply. Much more subdued recovery. Essentially, we are at least above where we were at the end of 2022 when the pound recovered to 124. We're still above that, although not by much. You've just seen again this sideways consolidation since the beginning of April that has left sort of the buyers able to hold the price where it is, but frustrating sellers, but not able to get more than that really. We did briefly touch 125.42, which was the highest level there since the first part of June of last year, but not much more than that. So this one far more neutral. In fact, you could argue it's only just started to break out of the range that has prevailed here since the end of the year, really. The first time we hit 124.40 and then a sideways movement since then. We're just moving out of that range, which is unsurprisingly difficult to break out of because of the mix of good and bad data driving the pound here. Good in the sense that we expect the BOE to keep hiking, but if US GDP data on Friday comes in stronger, that could negate some of this potential breakout view here. And then turning to dollar CAD, which is something we don't cover often enough, but certainly a very strong performance here from the Friday lows, partially helped by that weakness in oil prices, which we'll come to in a second. But so far ignoring the strength we've seen in the last couple of days in oil. So really, again, because the Bank of Canada was the first really to move on in a big way on rates with a 1% increase, 1 percentage point increase, you want to be picky about it, that really sort of gave the Canadian dollar a bit of a lift. But since then, you've seen a big recovery in the US dollar and a willingness to push this one higher again. So the fact it recovered back above the 200-day moving average, you've got a MACD crossover here. That still sends the message the buyers are in charge. As indeed we've seen all the way through, actually. You've had to go back all the way into 2021. Still an uptrend, a very choppy one. It's not a smooth NASDAQ or DAX kind of uptrend. And so it's been full for all the way. But nonetheless, there's your uptrend. It has been a choppy one. It does require a bit of patience to trade. But nonetheless, that's what we're seeing right now. So with the buyers now nudging the 50-day once again, this is important because it tried to rally in the first half of April, and then the 10th of April, it hit the 50-day moving average and then dropped again. And the last 2 days, it's been contained by the 50-day as well, and so far today. So that's a slightly worrying sign. If it can get back above that and then back above 136, maybe we've then got a chance for it to push back on towards the highs from early March. Finally, turning to commodity prices, gold, touch weaker this morning, but again, a pullback continues here after what has been a very impressive run from the October lows. We can see we moved firmly to 2,000 and higher over the course of April, 2040. In fact, we got to 2049, I think, highest level there since March for gold prices. Overstretched in a sense, but as you can see, really, we've closed some of the gap with the 50-day moving average. It wasn't particularly a yawning gap. If you zoom in, it becomes a bit more acceptable. So you've got firm uptrend here. Maybe a bit more of a decline, a bit more dollar strength would push this one back down to, say, 1920, 1925. You might see some buyers emerge from there, something to keep an eye on as we head into the second half of the week. Otherwise, if you do see the recovery back above 2010, that puts us back on course to try and break through these mid-April highs for gold. And then crude oil, after taking a bit of a drubbing, it really more or less closed this gap. In fact, not quite really. You've got a bit more to go here. Closed most of the gap, though, from the OPEC surprise production cut over that weekend at the beginning of April. Failed to break the 200-day moving average, which, of course, was seen as a bit of a negative sign for oil prices. They couldn't do that. But now it finds itself sandwiched between the 200-day and the 100-day, bouncing off it yesterday, carrying on that move from Friday. So no desire to push it below there, or no apparent strength by the sellers to push it below that level. If it does, that would be a bit more of a tell that maybe the sellers have regained control here and back below 76.30 or so. And you could maybe argue that the downtrend is back on course, and we could, over the course of time, see a move back to the March lows. But for the moment, probably more neutral than anything else, because I think, yes, we are below the 81.60 up to 82 levels that were the peak throughout December and into March. And that's a tick in the bearish box, but it's still holding above the 100-day. So we just find ourselves really in a neutral view at this point, which is fair enough. I think you don't always need to have a definite view on whether something's bullish or bearish. I think the fact it's below the 200-day was still inclined me more towards bearish, but the fact it refuses to go back below the 150-day would sort of negate that view to an extent. So maybe neutral mostly, but leaning bearish is the way to view crude oil still at the moment. Of course, if a recession becomes more likely, or seems to become more likely, you can expect that to be reflected in crude prices, and that might revive. So the fact that it's not really been able to capitalize on the surprise OPEC production cut any more than it did, maybe sends a message that people are still cautious about getting too long crude oil in case a global recession is the outcome towards the end of this year or into the beginning of 2024. So it's looking at the rest of the day. On the economic front, you get consumer confidence in the US and new home sales at 3 p.m. But it is, of course, the earnings that are the driver here. We have Alphabet and Microsoft after the bell. Before the bell, we do expect likes of General Motors, Visa, McDonald's. So do watch out for that. We've already had UBS and a number from the UK, and then tomorrow, of course, it gets busier as well. So that's the key thing to watch out for. Dow closed yesterday 33,875. We're currently expecting it to open at 33,720, so down about 150 points or so from where we were yesterday. So slightly weaker open for the Dow expected. Not surprising given the plethora of earnings this afternoon. But that's it for me. Thank you for joining us, and we will see you again tomorrow at 10:30.